Good morning and welcome to Charting the Markets on Monday, the 8th of January 2024. The Asian session with regards to indices has been another lackluster one with Asian equities, especially Chinese stocks, dropping on weak sentiment. And this comes after last week's non-farm payrolls data out of the US on Friday, which came in stronger than expected. But once investors dug into the numbers, they saw that there had been negative revisions or downwardly revised data for the last 11 out of 12 months, and also that the actual employment number had declined, all of which led to a rally of US equities into the end of the week after a dismal week in general. And this has continued with regards to the Asian session earlier this morning, with Asian equity indices coming off. Now, if we look at the FTSE 100, as you can see here, the daily financial bet reflects that a bit. We opened more or less where we closed on Friday, retested the lows, but have so far held or managed to hold above these. And these intraday lows on the FTSE 100 daily financial bet were made at 7,635. So as long as we stay above there, it's possible that we might see a resumption of the previous uptrend. And this could happen as congressional leaders in the US reached an agreement reducing the likelihood of a shutdown this weekend. And perhaps we can see a minor bounce back ahead of Thursday's US CPI data and also Friday's earnings seasons, which kicks off in the US. So technically speaking, what we need to see, though, for a bullish reversal to happen is a rise above Friday's high at 7,709. If that were to happen, we could then perhaps retest the high seen back in September and also in December of last year between 7,747 and 69. Now, obviously, all bets are off with regards to longs if we were to fall through today's intraday low at 7,635, because that would most likely indicate a slide then taking us down towards the red line here, the 200-day simply moving average at 7,575. Moving on to the German equity index, you can see here the DAX 40 daily financial bet. And what we've seen here is a slide to 16,444 on Friday on the back of those non-farm payrolls. And then this morning, we had a retest of Friday's high without so far succeeding to break through those. They were made at 16,648 on the back of strong German factory orders, which, on the back of Germany's trade surplus, which was the largest in 3 years. But we also had German factory orders rising less than expected, which dampened the bullish momentum somewhat. So here, not much is going on at the moment. From a technical perspective, though, what is interesting is that we are holding above Friday's low. As long as we do so, we could see a minor reversal to the upside, but for that to gain traction, we would have to rise above Friday's high at 16,648. Once that has happened, we could then target the 20th of December at 16,811 before we head back up again towards the early January high, which was made at 16,960. So that is a possibility, especially given the formation we've seen so far, which could perhaps be an Elliott wave ABC zigzag correction, which would mean that we would then have a follow through to the upside, take us perhaps to new all-time record highs in the near future. But all of that really depends on us remaining above the low seen on Friday at 16,444, because if that were to give way, we could see some further declines take us down again towards the high seen at the beginning of July of last year at 16,211. That's the possible downside target once we take out that low from last week and also the high seen in June of last year at 16,428. Now, as I've mentioned, in the US, we had over the weekend congressional leaders reaching an agreement reducing the likelihood of a shutdown, and that has helped equity indices stabilize. You can see here the NASDAQ 100 already on Friday after non-farm payrolls held on those November highs here, you can see. And right now we're trading in the pre-market session on the IG platform, slightly no, it used to be in positive territory, but now slightly negative territory compared to Friday's close. Now, what we need to see here from a bullish reversal perspective is us holding not only above 16,178 Friday's low, and also the lows going back down to the 22nd of November at 16,127 or 26. That is the line in the sand for the Nasdaq 100, because as long as we stay above there, we could see a bullish reversal after last week's 3.5% fall that we saw as a sector rotation out of tech stocks into, for example, banking stocks took place. Now, for the bullish reversal to gain traction, we would have to rise above Friday's high at 16,420. Once that has happened, the upside target, the first one, would be the 20th of December low at 16,551 in this scenario. The US dollar hasn't really traded that much up or down over the last few days. And you can see that on the euro dollar chart. As you can see here, we had quite a volatile session last Friday on those non-farm payroll numbers, and as they were dissected. And basically, we dipped down to 108.77, just marginally above this red line here and the orange line, the 255-day simple moving averages between 108.48 and 108.46. And basically managed to rally all the way up to 109.98 before coming off again and closing more or less where we opened the day on Friday. Now, today, as you can see here, very little volatility as we're trading around that close on Friday ahead of Thursday's US CPI data, which is really important. And we also have inflation data out of Japan and China this week. And not much may happen today because the economic calendar is really quite empty, so not much going on there. But basically, the breakout of Friday's trading range is going to be the deciding factor for the ongoing trend. So a fall through Friday's low between 108.77 would most likely take us down to these moving averages just mentioned between 108.48 and 46, whereas a rise above Friday's high at 109.98 would retest the November and also early mid-December highs between 110.09 and 17. And then once we were, or if we were to be able to rise above that resistance area, we could then resume the uptrend we've been in since October of last year. What really needs to happen is for us to hold above 108.77 for that to be the case. And similarly on cable, you can see on the British pound against the US dollar, a similar chart in that we sort of topped out at 128.28 at the end of December, slid down to 126.11 and have held there, having retested that level on Friday after non-farm payrolls, and then closed slightly high on Friday, but this morning not being able to retain those gains and instead sliding ever so slightly. So not much going on here, as you can see, very little volatility, and that will probably continue to be the case as we await the US inflation data on Thursday. Now here, for a bullish continuation to be seen, we'd need to rise above Friday's high 127.71 for us to retest that 128.28 high going back to December of last year. And last but not least, on the currency front, I'd like to also mention the Japanese yen. As I've said, we are expecting to see inflation out of Japan later this week. And here, what we've done last week is we rallied with regards to the US dollar against the Japanese yen above the red line here, the 200-day simple moving average at 143 yen and 31 sen. And basically, as long as we stay above there, we remain bullish. But short term, we're seeing some consolidation here. And we would have to take out the 145.98 high from last week for us to head towards the 55-day simply moving average at 146.80. And with regards to retracements, there should be really good support around the 200-day simply moving average at 143.32 in the short term. And then below that, we've also got the late December high on the 27th of December, which was made at 142.85, which may offer short-term support in case of the current consolidation phase continuing with regards to dollar yen. The US dollar basically rallied last week, and that had a dampening effect on the price of gold. But if you look at the gold price today, you can see here that we are sliding further again, having tried to stabilize on Friday of last week around non-farm payrolls. And you can see here that we're heading down again towards that low from last week at $2,025 per troy ounce. And if fallen through, we would then target the orange line here, the 55-day simple moving average, $2,013 per troy ounce. And then we've got this support zone made up of the October high and also the mid-November high together with this short-term support line going back to November of this year, which come in between $2,009 and $2,007 per troy ounce. So that's a possible support area. But as you can see here, if I correctly draw the uptrend line going back to the October lows, we are in the process of falling through that at the moment. So further downside looks pretty likely with regards to the gold price, provided we stay below Friday's high at $2,064 per troy ounce. Now, moving on to the oil price, we can see here that WTI futures, crude oil futures prices are once again sliding. And this is on the back of Saudi Arabia saying that it will cut key crude oil prices for buyers in all regions for February amid softening demand and rising oil supply from OPEC and also from non-OPEC producers also raised the likelihood of a market surplus this year, all of which has pushed the oil price lower, as you can see here. And interestingly enough, last Friday, we actually, and again this morning, failed at the September to January downtrend line at 74.27, which is really acting as solid resistance short term. And therefore, we may actually slip back again towards last week's low and also the low seen in December between 69.41 and 67.94, provided we stay below Friday's low at 74.27. And last but not least, I'd like to have a look at Chicago wheat prices. And as you can see here, Chicago wheat rallied to the 200-day simply moving average here in red back at the beginning of December, and then for 3 days tried to break through that moving average but failed. And interestingly enough, we saw something similar happening over the festive period at the end of last year, where for 4 consecutive days between the 26th of December and the 29th of December, we tried to break through that 200-day simply moving average, but without any success, and instead slid back down again to this 55-day simply moving average here in orange, which offered support last week. So last week we went down to 597 and then bounced off slightly to Friday's high at 626 before on the futures contract coming back down again towards this orange line here to 55-day simply moving average. So it looks to me as even if this were to be a corrective move in an uptrend, we may actually retest the 55-day simply moving average at 604.27. And if we were to fall through it and also through last week's lows at 597, we could slip further back towards the late October low at 575. So that is a distinct possibility with regards to the Chicago wheat prices, provided they stay below last Friday's high at 626 on the front month futures contract. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG.